This is video 4 on our series on borrowing power. In this video, we're going to be talking about, 5 or 6 good examples of what we've done in the past for previous clients and what we've managed to achieve. So first one, a client was limited with a big 6 bank at debt to income ratio of 7.4. All right, so I'm based in South Sydney, so this was a client that was from Wollongong, had 3 properties currently. They were going to switch their third one to investment and then move up to the Sutherland Shire and buy into a duplex for their forever home. He could see the prices running in the market, and at the 7.4 debt to income ratio, he was really priced out. He wanted his carrying bars, his Mirandas, his Guymies, his Kirawis, but at the 7.4 ratio, he was capped, even entering into the Engadine or the Heathcote market. So he came to me. We managed to get him into a mid-tier bank, which was a non-ADI, so a bank that isn't affected by ASIC and APRA rules, okay, and has very good serviceability or borrowing power for clients that have investment properties. So we managed to get this client a better rate than the Big 6 bank was offering, plus the debt to income ratio up to 9.2. Okay, so they settled just before Christmas, and they extremely happy. They just managed to get into that kind of carrying bar and Miranda market. All right, and really because of the work that we did talking about how we negotiate and talk to real estate agents, it was actually a duplex that was like 2 or 3 months from completion, and they were having some problems with council. So even though they could have potentially gotten a higher offer from someone else, the fact that they were willing to go unconditional now and have a delayed settlement to match what the seller wanted was how he got into the market. So it was perfect. Okay, second one we got. It was an electrician in the Sutherland Shire again. He'd worked as a PAYG full-time worker for a very long time, always earning kind of between 80 to 100,000, which was great. Went down that ABN route. Okay, so sole trader, ABN, got all his insurances, and really with tradies, you've got 2 options. You can go out in the market and find all your jobs yourself, potentially have a higher margin there but higher risk, or go down the route where you're subcontracting to a major, which is like a Freedon or something like that. Now I won't disclose the company, but that's exactly what they were doing, subcontracting to a major. So what happened was they spent 1 or 2 months with a family before they knew that they were going to start increasing their income. First year, 80k income. Second year was 135k income. Went to a major, got pre-approved for just over 600,000, and as self-employed, the current bank was willing to use the $80,000 income. All right. Now, after they came to us, there are 3 self-employed banks, that 2 are majors and 1 is a mid-tier, that will go off the most recent year's tax returns, even if there's a big gap in the income, which is exactly what happened. And we managed to get the borrowing power up over 950 to $1 million. So from that point of view, the client was really happy. All right, so they settled in the last couple of months as well. All right, we've had another one recently, which was an older client. They were over 55 and starting to ramp down on their careers, but they had a very large investment portfolio because their income was great at one stage, and the LVR on the portfolio was really good. So we're talking about the loan size compared to the value of the property that they had, and they had quite a few properties. Now, not a lot of clients know that certain banks have rules that you can't use more than 50% of your current rent that you're receiving as income on a total application. So the client got capped at about 850 and couldn't move a lot of the properties or refinance, which we ended up having a situation where we selected the right bank, we wrote it up correctly, we showed the low risk of the total portfolio, we showed that they'd been paying down their debt over the last 2 years and had a plan to pay it off before retirement age, and we managed to get the loan size up to 1.35 million, which enabled them to have an extra 100,000. So they did 2 renos on 2 of the properties, very cosmetic. So they're not moving walls or anything. They're just updating things, increasing their rental yield after they do the 50k reno in each. And from that point of view, got the client exactly what they wanted. Plus, we ended up saving them just over about $7,000 interest per year. We're not including bank rebates and things with refinances, but the interest reduction was quite significant due to the size of the portfolio. All right, so that was one. So, over 80% of banks, if you've got more rental income than your base income, they'll limit you. Okay, so then there was another one. We had another client who was a credit card churner. We checked them on creditsavvy.com.au, made sure the credit score was good. Made sure that they were maintaining their payments and not going over the limit, and they had less than 15 inquiries over the last 5 years, so within banks' acceptable ranges. They went to a bank directly. The client pushed back a bit, wanted to maintain the limits, and ended up getting a pre-approval, which they chased the market for about 3 months and they weren't happy and they came to us. After we talked about it from a more holistic standpoint and really the limiting factor with the credit cards, because not many clients know that the limit, they go off the limit, and most banks will do 3.5% of whatever limit you've got, and then they'll add it to your monthly living expenses. Once the client understood this, and really after the first pushback, really we brought them back to what their goals and needs were, then, do you want the property or not? And at the end of the day, the client wanted the property. So we didn't close down all the cards. There was like 5 or 6 cards. We closed down everything but 2, reduced the limits severely, and then we got their borrowing power up 200,000 just by doing that. Okay, then there was another client working for a very similar tech kind of company like an Atlassian or a Google or a Facebook. So you'll see a lot of the time they'll pay these large bonuses per year with vested shares over a 3-year period, which they can't sell. All right, so you'll have these guys have these overseas brokerage accounts with very large share portfolios that they can't sell down until 3 years, and then they can sell the first year after the 3rd year, things like that. So a lot of banks, they'll look at bonus over your last 2 years, and then they'll go off the lower figure. But if you go over 30,000, some banks start getting funny, and let's be honest, it's about 50% of banks. Okay, this client's bonus was 90,000, and that was the lower of the last 2 years, and the other one was just over 100, so it was very similar. All right, so all we did was we chose a bank in the mid-tiers that accepted the bonus level, and we provided supporting evidence of more income over the last 2 years, full-time employment. The company was over 5 years. So we're just reducing the risk from the lender. They don't want to use the secondary income, which spiked this year, that won't be given next year. Okay, and then managed to get the client up significantly on their borrowing power. All right, I won't talk about the exact figures on that one, but it was more of we went to a bank that was a little bit more lenient in the mid-tiers. Then we discussed the overall risk profile to the lender. Then we talked about the work history, their education, how long they've been with that company, the fact that they've got a promotion inside of the same business. They were looking to stay very long term because they were a key part of a team, and that the last 2 bonuses were within 10 grand of each other, which is exactly perfect. So even though the bank only needed, your 2021 tax return and your last 2 years bonus, we gave the additional income data for the prior year to show that it was consistent, which is how we got everything done. Okay, then another client, we got a PAYG contractor. They've gone through the Westpac group, which typically aren't the best with PAYG contractors. They've got funny rules where because a lot of the time PAYG contractors, let's say you're working for a large company, okay, but a lot of the time the PAYG contractor isn't directly associated with that company. They use a labour hire business between themselves and the actual company to make payments and manage everything. from a contracts basis. So they were on a 12-month rolling contract, but the Westpac Group have funny rules around how long you've been with your current contract, how long you've got left with your current contract, and even though you've been with the head company for longer, say 2, 3, 4 years, it doesn't matter. They go off the labour hire company. So if that switches every 12 months, it's very hard for you to get approved or at least talk about this with a number of banks. So they were causing a few issues, and I think they would have gotten something across the line eventually. But came to us. We went to a lender that's there's probably 5 or 6 lenders that do probation periods very easy. So, you know, you've got a person that's coming out of university with no work experience having their first job, and then they've got a 6-month probation period. Those kind of lenders are very good and easy to deal with on a PAYG contractor basis. Okay, and we managed to get the deal done inside of, say, a week and a half. So again, certain banks cause an issue, and they still might come through with the money, but they're much harder to deal with structures for PAYG contractors. Okay, we've also seen other ones where they had, say, 3 months left of a 12-month contract, and the bank wanted to see the renewal notice before they'll issue the formal approval. And other banks, as long as you give them the work history and show that they've been contracting for a certain amount of time, other banks will accept that, so we won't need to wait the 2 or 3 months for the renewal. All right, so that's another one. Last one. The refinance that we did, this was about 4 or 5 months ago. So it was a client that went through with a big 6 bank, and they wanted to refinance, but then found out that the borrowing power wasn't there. Okay, they looked at the total scenario, and really the main 2 things that stuck out were the 2 car loan payments that the clients were making, and really they didn't want to go down the route of selling the cars, paying out the car loans, and, you know, downgrading the cars. Okay, so what we did was we found out that we ordered 3 to 4 valuations, and found out one of the valuations came in much higher. Okay, the client's car payments were at 6 to 8%, when the mortgage is sitting at, you know, 2 to 3%. Now, a lot of people, what they'll do is they'll chuck the car finance payment directly into the mortgage on a 25 to 30 year term. So they'll think that the overall repayment is low, but then once it's stretched out over a 25 to 30 year period, you're in a position where the total interest that you pay is larger, because you know, it's sitting on the normal home loan term. So if you don't make extra repayments and pay it off, you're actually, even though you're saving now, you know, over the 25-year period, you're paying a lot more. So what we normally do in these circumstances is we put the car loans on a separate loan split on the same term that they're on at the moment, to force that car loan to be paid off over the same term. So we go from a 6 to 8% interest rate blended over the 2 car loans, refinance them into the mortgage knowing that the valuation came in higher. Okay, put them on a separate loan split, so it means that the 50 to 70 grand worth of car loans are sitting on a separate loan split, and then making sure that the term of that loan split is on a shorter loan term. So I think it was on about a 4-year loan term, which makes sure that you pay it off over that time. So that's really what we've done with some of our clients in the past. So I just wanted to give you a couple of examples, because in that last one, obviously if you've got 2 car loan payments coming out at, you know, $400 to $600 a month, coming out, or up to $800 a month, and then you refinance, pay that out, you know, reduce the interest rate, put it on a loan split on the mortgage, make sure it's paid off over the same term over the 4-year period. We managed to increase the borrowing power enough to get them across the line to get the refinance done. And obviously from the lender's point of view, they see it from a risk standpoint, they see it much better off because they're not seeing all these extra repayments coming out for all these other liabilities. So they're all for paying off liabilities and making the overall risk profile of the client to lower, and also from the client's point of view, reducing their overall repayments, which again is another benefit. All right, so these are just some of the examples of what we've done in the past regarding borrowing power. There are so many examples of what you can and can't do as long as you've got the experience and you're going through with the right lenders. All right, so this is video 4 on our borrowing power series, and we'll see you on the next one. All right, then, bye.